It looks like we are on. Cam, I can see you, which is a good start. Right, everyone, welcome to the update that we've got relating to the forces shaping New Zealand for 2026. For those of you who don't know me, I'm Troy Turner. I'm the managing partner for, there's now 4 organisations in the Inside Group. So we've got Inside Recruitment, which is the business we've kind of operated since 2007. We've got Onsite NZ, which is a newly branded business, which looks after small to medium and does some recruitment process outsourcing work as well. We've got Hum Consulting, which is where Matt Cooney sits. That was formerly Inside Consulting. And we've also got Weirdly, which is our automated technology, which does a whole lot of volume recruitment in the client-facing kind of space, graduates, and also kind of healthcare space as well. So quite a lot sitting in the group now. But that's not why we're here today. We're here today because I really wanted to give everyone the opportunity, including my good self and my team, a chance to hear about what is shaping New Zealand in 2026. It's been an incredibly interesting period since 2020. And today kind of shows just how interesting it is. I think we've got something nearing 450 people kind of registered to listen to Cam, which I can understand why they would do that. So, it's hugely interesting for everyone just how much they've got into the economics and what is actually shaping New Zealand. And as we've seen in the last few days or the last week, what is shaping the world. So, today what we're hoping to cover, and Cam will cover off, is, signals to watch, signals to ignore. We're also going to cover off, where confidence might be emerging. I'm hoping we might be able to give you some understanding of what it means for you if you're a leader, what it means for you if you're an employer, what it means for you if you're a candidate or someone who's just wanting to navigate the employment market in the next kind of 6 to 12 months. Can you do that with some confidence or not? And then Cam has given me a new term. He's also going to do some Jandalnomics. So he's going to give you some Jandalnomics update, which will be good as well. So I'm just going to pass over to Cam. Before I do, for those of you who don't know Cam Baggery, very distinguished. That's probably not the word you'd use for Cam all the time, but he's a very distinguished in the space of economics, former chief economist for ANZ, now sits on boards for the likes of Life Education Trust, and also provides kind of banking services, independent economic advice. So I'm really stoked that we get independent economic advice. And Cam, what you'll hear today from Cam is a very straight up view of what's going on, a very balanced view of what's going on. But I really, first and foremost, hope you enjoy it. Cam, over to you, and thank you very much.
Well, thanks, Troy, and welcome everybody. Just to sort of check first up, Troy, can you see a slide in front of you? Right, so I think we're sort of good to go. Look, obviously there's an awful lot going on. I'm just going to give people the bigger picture, right? And it's pretty simple. New Zealand at the moment is at what we call an inflection point, where we're caught between cyclical tailwinds. The Reserve Bank's taking the official cash rate down to 2.25%. They're trying to stoke domestic demand, aka the housing market. They're not having much luck. Why are they not having much luck? Because housing's fundamentals are not that great. And that gets us to the other side of the equation. You've got cyclical support, lower New Zealand dollar, interest rates, but it's clashing with structural challenges. And this is why we call it a big reset in regard to what's going on, because what we've done for 10 to 20, maybe 30 years, we've sort of pushed the boundaries of conventional economics. If you want an illustration of that, just look how far we saw the housing market get out of whack in regard to valuations. So when your valuations are out of whack, eventually it doesn't matter what the Reserve Bank does. The market's just going to struggle to respond, which is what it's doing at the moment. But there's a whole lot going on. I note that the OECD, that they produce an economic survey for every country every couple of years, and what they said in the Australian one, I found really interesting, because what they basically hit the nail on the head in regard to is that occasionally you need a good old-fashioned clean out, because bad firms get taken over good firms, and that's how you drive what's called productivity growth. And guess what? You need productivity growth to drive living standards, to drive the economic base, which our well-being is built upon. And there's an argument here, and I like it, but when you don't have real economic clean-outs, i.e. the Reserve Bank gives everybody a release valve the government goes and pumps a whole lot of money into the economy. Yeah, we US Federal Reserve, central banks around the globe, they print a whole lot of money to avert decent downturns. What takes place is that you eventually over time impact productivity growth because you don't get the weak getting taken out by the strong. And I know that's not people don't like to see downturns, and there's good reasons not to have a downturn because you get this displacement economic effect where people lose their jobs, etc., etc., etc. They lose their skills. So there's good reasons for what central banks and governments have done over 20 to 30 years to protect the economy from good old-fashioned recessions. There is an unintended consequence of that. And the unintended consequence is that you end up with a more protected economy, which eventually hits productivity growth over time. Yeah, so the OECD, I've been liking this line for a while, but it was good to see the OECD come out and be very pointed in regard to this in the economic assessment of Australia. But exactly the same thing is going on here in New Zealand. There's a lot of chatter out there at the moment, blame towards the economy. The government likes to get the finger gets pointed at again. There's a little bit of background. At the end of last year, in fact, around October last year, they had what's called Mood of the Boardroom, which is a big survey where corporates, big business New Zealand, effectively provides feedback into government over what they need to do. And Fran O'Sullivan asked me to write an article, and I said, I'm going to write you an article, Fran, and the article is going to be about the performance of the boardroom as opposed to the mood of the boardroom, because there's a lot of finger pointing from the boardroom towards the government, and there's not an awful lot of finger pointing towards management and the performance around boardroom tables. And we're not going to go into names here, but there's been an awful lot of wealth destruction around New Zealand, and there needs to be some corporate responsibility in regard to what's sort of going on. And this is a realm of economics, which is what we call microeconomics. Macroeconomics is interest rates, the currency, the housing market, inflation, etc., etc., etc. And everybody likes to point the finger at macroeconomics, particularly when we're going through tough times, and we have gone through tough times. But there's not an awful lot of what we call corporate or microeconomic responsibility in regard to what's going on. And I'm just going to give people an anecdote, which sort of ties in with slide one as well. There's a red meat company down in Southland that got itself into difficulty, and ultimately they needed to get bailed out by the Irish. So the Irish came in, recapitalised the firm. One of the things that the Irish did, and this was relayed to me down at Waimumi Field Days, and it's a great anecdote, was a big red meat processing plant. The throughput, i.e. the number of carcasses on a hook through this plant, was typically running about 75%. So 25% of the hooks didn't have a carcass on it. This organisation brought in drug and alcohol testing, which they were scared that they might lose a whole lot of staff. They did lose some staff, but guess what's happened? The number of carcasses on a hook has gone from 75 to 94. Now, that's just an illustration over good ideas displacing bad ideas and a little bit more corporate responsibility starting to come through the system. And the red meat company down south, and once again, I won't name names, they're back in the game, and watch them in the next 12, 24, 36 months, because they've got the farmers back on side and they're on an upwards trajectory, which is going to be very good for that Southland region. But it's just that's an anecdote of some of those microeconomics that I see. Big picture we need to appreciate is also what's going on around the globe, and you cannot ignore geostrategic or what's called geopolitical driven decision making at the moment. The world is now on edge, and Donald Trump, what we call the new sheriff in town, he's looking at reindustrializing the US economy. You've got Scott Bessent and others, US Secretary, head of the US Secretary, can't remember what his role is, but he talks about having gone to a highly financialized economy, and Wall Street's done great, but now it's Main Street's turn. And this is the tectonic shift where people are now talking about our rules-based system being undermined by countries exercising power But it goes a lot further than that. There's a hammer and tong argument going on between China and the United States. And of course, China is our largest trading partner, about $19 billion worth of export goods. The United States is number three. Australia just knocked them off second spot. But American exports are out and dying 9.5 billion. But it is a fundamentally different world that we now find us in compared to what we've been used to previously. And when you get into that sort of world, you tend to have to look for what's called rabbits out of the hat. And I'll talk about the rabbits in a second. But yeah, given what's going on in the Middle East at the moment, look, we cannot ignore this. This is not just about oil prices. If you ever look at the mean, i.e. average lift in oil prices, when you go through some sort of shock, the average lift is around 50%. Median around 25, 26%. Now, the hope is that this is going to be a very short, very surgical, targeted war where Iran gets cleaned out and oil prices, after temporarily going up, it becomes a good economic outcome and they come crashing back down on the other side. There's a couple of problems with that. Problem number one, if I have a look at history and I have a look at the experiences we've seen with the likes of Afghanistan and Vietnam, they were not short-run events. Never underestimate anyone on their own turf. Yeah, the United States at the moment is going for air power supremacy. They've got naval supremacy, but yeah, this is a war that's going to get fought by modern technology, aka drones. And that Strait of Hormuz, it's absolutely critical, and it's not just in regard to oil and gas. It's things like fertilizer, because gas is the main input into production of fertilizer, and an awful lot of fertilizer hence comes out of the Middle East. If you don't have fertilizer, you impact the food production system. And one that people are not talking about enough at the moment is water. The Middle East, that part of the world is not exactly blessed with an awful lot of water. Now, they produce water by distillation plants. And if you want to take out some strategic assets, you target water-based facilities. So, I think this thing's got a little wee way to go. And one of the real risks that we're worried about here at the moment is that what if this translates into more global inflation when you've already got central banks that by and large have got inflation around 3%. Now, inflation at 3% is not that bad, but inflation is supposed to be around 2%, which is what central banks' mandates are. So the last thing any central bank wants to see at the moment is some sort of oil price or even food-related inflationary shock that comes through the system, aka a bit of a repeat of what we saw during the COVID sort of times. Going back to unleashing a bit of a rabbit out of the hat, I don't think people are paying enough attention to India. India is knocking on the door of being the world's third largest economy. They're going to take third place sometime in the next 12 months. It's an economy that's growing at the moment around 8% per annum. Now, if I ever look at a parallel between China when we signed the free trade agreement and India, we saw some remarkable things in regard to ex post the FTA with China that was not just about trade and goods. We saw a big, massive inflow in visitor types coming out of the likes of education. Did we see an uplift in business-related travel in regard to share post the FTA? The answer was no. But we saw a big uplift in regard to education. All of a sudden, China went from being about 6% of our tourists to up around 10%. A lot more visiting friends, relatives. So there's one leg of a free trade agreement to think about what's called trade and goods. The other legs are trade and services, capital, and trade or flows of people. And I think people are underestimating what that people connection could actually be. Another theme that we hear an awful lot of in the media is that big exodus of New Zealanders to Australia. And of course, if a lot of New Zealanders go to Australia, tightens up workforce availability. But what it also does is that it dilutes the potential for the housing market to springboard because you just don't have decent demand. A couple of things I just want to bring to people's attention, because I don't think Australia is going to be the lucky country for the next 2 years. If you look at the relative forecasts for the likes of the Reserve Bank of New Zealand, Reserve Bank of New Zealand is predicting 3% growth about 12 months out for New Zealand. Conversely, the Reserve Bank of Australia is predicting 1.6 for the next couple of years. Now, that is a massive outperformance swing in favour of New Zealand that we do not often see. And one of the big reasons for it is that, look, we think we've got an inflation problem here in New Zealand. Inflation is 3.1%. Inflation in Australia is 3.8%. The Reserve Bank of Australia has already lifted interest rates once. They will lift interest rates again in May this year. They have to get on top of inflation, and it's going to be a very awkward, very prickly position for the Reserve Bank of Australia to do, because that is bad for growth. It is bad for your labour market. So I've got a suspicion Australia is not going to be the so-called lucky country. And when you start to see economic performance shift in New Zealand's favour at the expense of Australia, watch the space in regard to what we start to see in regard to trans-Tasman migration flows. Another stat that people are not aware of, if you look at something like unit labour costs, your unit labour costs in the last 12 months in Australia, which is wages divided by productivity, up 5.4%. In New Zealand, unit labour costs are rising around 2 to 3. If you look at unit labour costs in Australia over the past 3 years, they're up 15%. What that means is that there is an awful lot of Australia, particularly some sectors such as construction, that is becoming progressively more uncompetitive. And when you become uncompetitive, you look for alternatives. And I note that the Kiwi Aussie dollar is now around 85 cents, so all of a sudden it's becoming cheaper to source materials down here in New Zealand. And New Zealand exports into Australia are actually smaller than where they were in 2011. I watch the space in regard to New Zealand exporting an awful lot more stuff into Australia, and also those trans-Tasman migration flows. Coming back to that bigger picture, if you look at the past 20 to 30 years, we've called the past 30 years the Great Moderation. And the Great Moderation was this economic period where we had low inflation. We had 9 years out of 10 of pretty good growth. Low inflation means you're going to get a trend lower in interest rates. We had a globalised, trusted, very connected world. It was a world all power to the employers. Demographics were a tailwind. It was a world of abundance, a world of stability, efficiency, just in time. We saw 1 year in 10 went bad, but 9 years in 10 were good, and we had remarkably low economic volatility. What we also saw over that period was an economic model that was really falling apart. Because when you take interest rates down to record low levels, guess what? You have a housing affordability crisis on the other side. You start to see real tension between the younger generation versus the older generation. You start to see rising inequality, and of course, when you see rising inequality, eventually that morphs into fragmentation and crime, which is now. You've gone from a globalised world into a world with fragmentation and distrust. We've now got 3% inflation as opposed to sub 2% inflation. It looks like interest rates are going to be going up in 2026, and interest rates didn't go down as far as what a lot of people hoped. The demographics are less favourable. There's a structural shift, in my view, across the labour market, because demographics are no longer a working age population tailwind. So you've got a little bit more rising power of the employees. And I know there's an awful lot of talk here about AI displacing a whole lot of jobs. There's a whole lot of jobs that I don't think AI can displace. And peak in this economic cycle, we've seen unemployment rise to 5.3%. When this upswing kicks in, you're going to start to see scarcity of workers start to kick in pretty quickly. Trade for economic reasons is now about security of trade. Just in time has now been replaced by just in case. And we've got an awful lot of populism out there. And that's fragmentation to the far left, the far right. It doesn't matter whether you look at the United Kingdom, Australia, the United States, even here in New Zealand, France, Italy, we're seeing growth in what's called the political periphery. It's the far left and the far right. And that makes political and policy decision-making incredibly difficult. But if you step back and you think about, this is just a different world. It's a world far more akin to the 50s, the 60s, and the 70s, which were not a bad period. But you might have 8 good years in 10 as opposed to 9 good years in 10, and you had to deal with a lot more risk, and the world was once again a different place. And I guess, here's a sort of pop quiz on the next sort of slide. If you've got an organisation that's going through a whole lot of change, transitions, who plays that critical role in regard to management, guiding them through those transitions, making sure your staff are engaged? But we need to see a lot of change, both at the corporate level, business level, also within central government, local government, and even in households. And you can look at HR functions in regard to who's going to lead or play that critical role when you're going through what's called change management. But there's no one really there that's out there sort of performing this role for households. So there's no one out there really performing that role across SMEs who don't have a human resource function. So what you've got out there at the moment is that there's an awful lot of confusion between previous practices, and people tend to look at the past 10 years and say, well, that's the playbook for the next 10 to 20. The problem is the last 10, 20, arguably 30 years has been somewhat abnormal, which comes back to that sort of structural dynamic. You're rolling into town and people are confused. Out there, I don't think things are as bad as what people make out. Because I look at a lot of indicators such as insolvencies, the unemployment rate, and yes, we know there's economic pain out there at the moment, and people tell me it's been as bad as the GFC. It is nothing like the GFC. During the global financial crisis, we saw the unemployment rate up around 6.5%. It looks like the unemployment rate this time around peaked at 5.3. Yes, the house prices have fallen an awful lot further, but in the preceding 3 years, house prices moved up an awful lot further. So sort of what goes up comes back down on the other side as well. So just an illustration of the new normal and this cyclical versus structural story. If you look at the Reserve Bank's forecast for house price growth, they're now saying around 4%. Now, if you dig into their forecasts and you do something pretty basic, such as index house prices to average hourly earnings, i.e. pay growth, what you saw over a long period, 2000 to 2022, was that, guess what? The ratio got explosive, i.e. house prices got unaffordable. Now, house prices have come back down. It looks like they're levelling out at the moment. What's the anchor the Reserve Bank is using within their forecast at present? Income growth. Now, that's not surprising. It's what's called common sense. It's not common sense for house prices to be growing at 7% and income growth to be growing at 4%. You create a housing affordability crisis. And your house prices have come back down, but if you look at the ratio of house prices to income, they're still double where they were in 2000. So lo and behold, we've seen, and it's taken a bit of time, the banks to downgrade the estimates of house price forecasts. There's an abundance of housing supply across New Zealand. The rental market is not picking up. And this is having your real economic impact, because traditionally, when you want to get the economy going, the Reserve Bank stokes the fire of the housing market because it's normally very interest sensitive. The housing market is not firing up at the moment because, one, the fundamentals are not that great, and two, your valuations are poor. So the fundamentals is just housing supply relative to demand. And around pretty well most of the country at the moment, we've been building too much stock. And you can see that within Trade Me rents, that rents are under pressure to come down. So the housing market is not at the epicenter of driving that economic recovery, and nor is the Auckland region. What we're seeing, and I was down at Waimumu where I got that anecdote about the Southland Red Meat Company. and where we're seeing the strongest momentum in New Zealand at the moment, it's coming from the deep south. It's Southland, it's Otago, it's Canterbury, it's out in some of your regions. The laggard out there at the moment is, of course, Auckland. Now, once again, if you step back and think about the bigger picture here, the economy is going through a big economic transition because our old growth model of selling more expensive houses to each other, well, that made no sense. Your migration, tourism in China alone is not a self-sustaining model. You relied on cheap energy. Now, that economic model worked, but it had side effects, i.e. housing affordability hit the younger generation. But for a long time, people got very wealthy just buying and selling houses or buying and holding onto houses. You didn't need to take an awful lot of risk to make an awful lot of money. And what I also think took place across Wellington and central and local government here was that when you got an economic model that supposedly works, you can get away with lax economic policy. The problem was the economic model was partially working, it wasn't fully operating, it wasn't self-sustaining, it wasn't going to be durable. And what we're seeing at the moment is that suddenly people have woken up to, we need a bit of productivity growth. The productivity growth in this country used to be 1.4% per year. The decade average is now 0.3. You need capital investment. We need to be unlocking those natural resources. We need to be better at taking and managing risk, aka not just buying a house and expecting the house to double in value every 10 years. And we need a lot more tough policy calls. And this is, I'm quite hot on the theme at the moment about a little bit of a rebuild across the Wellington policy circle, or particularly key central government agencies. And I'm going to put a sing out here to Treasury and Ian Rennie. Ian Rennie has came in and Treasury is engaging now. They're starting to take a lot more of a firmer view on some key issues such as superannuation, such as management of Crown assets, and such as the challenges we face in regard to the fiscal cost of an ageing population. And we need to see a lot more of that stuff out of other organisations in New Zealand. I'm hearing good stories out of the new head of the Ministry of Education as well in regard to big cultural changes are starting to take place. But we've got away with what I call relatively lazy or easy policy making for a long time, because the headline in regard to growth looked like things were going okay. Well, they weren't. It was a failed economic model that was not going to be self-sustaining, and now we're trying to rebuild that economic model. So here's something that might sound a little bit ironic. You're working in policy circles, aka a government department, or even a local authority for that, which could be helplessly exciting in the next sort of 5 to 10 years. Why? Because we need to embrace an awful lot of change. I talked about labour productivity. One area of productivity where people don't talk about is what's called capital productivity, or how we manage assets. And capital productivity in New Zealand is generally a negative number. So we build stuff, then we must manage it. And guess what? Someone pays a price. If you want a localised example of that, just have a look at Wellington Water, because they had the decision years ago to pump more money into the system. They decided not to. We decided to go spend a whole lot of money on the sort of frilly sort of stuff. And now all of a sudden we've got a structural problem, and a lot of it just comes down to mismanagement. Once again, bigger picture here is really simple. We talk about labour productivity, workers, but not about asset intensification or doing the right stuff in regard to management of assets. And this is corporate management of assets. And I can point to some listed companies that have destroyed an awful lot of shareholder value, but I can also point to the management of education, health buildings, management of roads, and management of water facilities around the country. We cannot have an economy where capital productivity is consistently negative, because ultimately ratepayers and taxpayers end up being on the hook for an awful lot or more checks down the track. I did a calculation the other day just to work out what my rates bill has gone up in the past 5 years, and the answer is in excess of 90%. So yeah, the chart on the left just gives an illustration of Wellington Council rates revenue. It's gone from about 140 million in 2004. My estimate for this year, this is a Stats New Zealand figure, which is slightly different to what the official number is, but it's not too dissimilar. They now take, this year, I think they're going to take in excess of 600 million worth of rates revenue. Now, that has been a mind-blowing increase in the past few years, and you start to wonder about whether these things actually start to make Wellington progressively an unlivable city. Now, it's not just Wellington. We're seeing this across Hamilton. We're seeing this across Tauranga. And yes, we have underinvested in assets for a long time, so rates needed to move up. But I look at those sort of increases, 90% in 5 years, and that is absolutely mind-blowing in regard to what that means. And what's going on across households at the moment is that the Reserve Bank is pumping money into the economy because interest rates are lower than where they were 2 years ago. Your energy bills and your rates bills is taking that saving and putting into someone else's pocket right out the other side. And this comes back to management of assets or investing in the right assets. But there is a lot of attention because of this towards what's called rate capping. Rate capping, I've worked on it. It's not an end solution, but it's a partial step. Out there at the moment, look, confidence is pretty high. Consumer confidence is lagging. Why? Because people are still nervous about their jobs. But if you talk to businesses out there at the moment, they're confident that the next 12 months is going to be better than the last 12 months. The economy has turned the corner. One of the things that I'm keeping a close eye on, though, is what's called pricing intentions. Your pricing intentions, this is the ANZ survey, typically average around 20. That's a net balance figure. It's now up around 50. That tells me a whole lot of businesses want to recover lost margins, particularly in the retail sector. But we are seeing an economy that's recovering. But this recovery, you need to understand change versus levels. Right, so if I have a look at retail volumes, for instance, the retail sales volumes, that's stripping out price effects. Core retail and total retail sales volumes have increased for the past 5 quarters. If you look at retail sales per head, it's not exactly giving you a positive economic story in regard to what's going on. Because if you look at the orange line, we're well below where we were in 2020, 2021, and even 2022. And this is where, when you turn the corner and we're getting growth, it can actually hide or massages away the real story, which is the levels. So the characterization I put on this is that we're climbing out of a hole, but we're still in a hole. It's going to take another 12 months before we get that level of activity back up to more consumer and business friendly sort of levels. Politics, you can't get away with that when you're living in Wellington, because obviously the Wellington property market does an awful lot better under a red hui as opposed to a blue hui. What we're seeing within the Ipsos Issues Monitor is a big mood swing. Back pre the last election, the National Party was assessed as being best able to handle all of the top 5 issues, most of the top 10, and most of the top 20. The Ipsos Issues Monitor that got released earlier this week is telling us a different story. Labor is now in control of 3 or 4 of the top 5 issues, and Labor now dominates on 14 of the top 20. Now, what that is telling you is that this election is going to be a very close run thing. The economy tells me that the incumbents are going to get back. The inflationary pressure we're seeing out there at the moment suggests there's going to be a mood for change. So, I think this is going to be a very, very close election. So watch this space with interest. If you look around the country, where we're seeing the growth is coming from the Deep South. If you look at who's got the highest unemployment rate in the country, it's Auckland. And it takes a fair bit to knock off Northland, but Auckland has. And that just gives you an idea that the housing market in Auckland is still stagnant. It's not going anywhere. Even up around areas such as the Waikato, Bay, Plenty, Gisborne, has seen rising unemployment. Conversely, wherever you've seen unemployment rate either stable to start to come down, Otago southward. And that just gives you an idea about where the growth is coming from. What we're also seeing is within this economic cycle, employment lags. Hours work tends to be a little bit more of a concurrent economic indicator. So you don't go out there and hire staff immediately. If you've got, the demand side of your ledger starts to pick up, your first port of call is you work your existing workforce a little bit harder. And that's what we're starting to see out there at the moment. A caveat on that, because it doesn't matter whether it's an employment or an hours worked economy, the fact that hours worked is up about 2.1%, 2.2% in the last 6 months, and I don't think the economy's lifted that much, tells me the productivity story is still basically zero. And that I find a little bit troubling, even though it's encouraging to see the hours worked response that is leading, but it's going to take a little bit of time. I know there's an awful lot of talk out there at the moment, and you've got to be wary of what we call headline-nitis. There's a headline I read about Wellington being left in the dust as the economy struggles to keep up with the economy. Soft labour market, a whole lot of job layoffs across the public sector, etc., etc., etc. Well, there's different labour market indicators. So here's one to look at. Hours worked in Wellington is up close to 3% on 12 months ago. So yes, employment might be down, but what we're starting to see is that early indicator of a recovery in the Wellington labour market, which comes from hours worked, is starting to kick into gear. Not as strong as the general economy, but it's still starting to kick into gear. And this is common sense. When you start to see things start to turn around, guess what? You work your existing workforce a little bit harder before you take that punt and get out there and advertise for an employee. And we're starting to see that early indication coming through more broadly across New Zealand, but it's happening in Wellington as well. So just be a little bit wary of what we call headline-itis, because headline-itis, can be very exaggerated in regard to what's going on. Obviously, the Reserve Bank took the official cash rate down to 2.25%. Best expectations at the moment is it looks like it's going back to 3%. Is 3% a scary number? The answer is no. 3% is what we call neutral, i.e. where the Reserve Bank's neither got the foot in the accelerator or the brake. So interest rates are starting to move back up. Why? What's called core inflation, underlying inflation, it sits around 2.5 to 3. Now, this is where the Reserve Bank's got a bit of a problem here at the moment, because we're getting growth, but we're still coming off a low base. The economy still needs support, so you can't really lift the official cash rate too soon, but you don't want to get behind the curve and let inflation get away here. So they've got a pretty watchful, and they've got a very delicate balancing act to strike here, particularly if we start to see the likes of fuel prices move up, which is a tax. So when something's a tax, it takes money out of your pocket, so you can't spend on other areas, but it still adds to inflation. The government's talking a very big game about what's called fiscal consolidation. That hasn't started. If we see what we've seen in Wellington is what we call spending consolidation. We've not seen fiscal consolidation because the operating balance has continued to deteriorate. What we're now starting to see is, what we've seen for the past 2 years is that we've seen two expansionary budgets. The 24 budget was underpinned by tax cuts, the 25 budget by investment boost, and then the government sort of shuffled the debt in regard to expenditure to make the numbers stack up. The next 3 to 4 budgets in New Zealand are going to be very, very difficult to deliver. Any government of the day is going to be in a fiscal straitjacket in regard to they do not have an awful lot of lollies to dish out. Health is a huge problem. The roads of national significance, Chris Bishop has already acknowledged there's no funding for it, so everybody's not going to get what they wanted. All of a sudden reality started to set in. I don't know where the government's going to get the money for the defence spending that they're promising, to take defence spending from about 1 to 2% of GDP. So there's, some areas of the economy it's going to see the fallout, but other areas such as defence, boy, there's going to be an awful lot of money that's pumped their way. So finally, because I want to get into some questions, just a few key themes, because there is a lot going on. Do not underestimate security as a theme globally. We've been in a commercial orientated world about just in time for a long period, aka about 30 years. Security, commercial, geostrategic imperatives are absolutely massive. And there's a derivative of that. If I have a look at what we're seeing in the UK, Middle East, the United States, I don't think it's going to be too hard for New Zealand to fill its boots in regard to getting an awful lot of people to come down into New Zealand, because security, safety is going to be a big theme. We're in a process of rebuilding an environment for taking and managing risk. We played the safety card too much. At the epicenter of any economy is the ability to take and manage risk, and the capital productivity stats tell me we're not good at it. I hear an awful lot of sort of negativity towards Wellington City or the Wellington region, and people tend to mix them up. Yes, Wellington City has struggled, but you go up the Kapiti Coast, you go have a look at the people that are mobilising into Levin, you go over up into the Wairarapa. When people talk about Wellington, they've got to be very, very careful what they define as Wellington, because the Wellington region is not going that bad. Wellington City is obviously struggling more than the Wellington region. So people just got to be real careful about their narratives. I'm quite hot at the moment on the importance of a lower North Island growth strategy. Wellington tends to talk to or focus far too much about Wellington itself. We need to be collectively scaling up with your Manawatu's, your Wanganui, that sort of business central sort of hub. You think about the lower North Island equivalent or subset of the Golden Triangle. There's too much what we call Wellingtonitis, i.e. we think with a Wellington lens is think about a broader lens in regard to connecting a whole lot of dots. Just an anecdote out there at the moment. I see the Centreport's volumes are expected to double in the next sort of 3 to 5 years. Now, that sort of stuff is not getting out there, but that stuff is really important in regard to what's going on. There is going to be council consolidation. I think there's appetites for it. Watch the space. Wellington's uniquely placed, connecting the north and the south. There's no other place. You're not going to be taking the ferries out of the connecting the south out of Wanganui. It's got to come through Wellington. Bigger picture is pretty simple on 2 levels. You've got cyclical support, which I talked about up front and through the presentation, is going head to head with structural headwinds. Now, we're going to be okay, but it's going to be what we call grumpy growth, because we need to reset in regard to getting the productivity up. And that's going to take, you can't do that overnight, because turning the wheel on productivity growth requires a whole lot of structural change, better management of infrastructure, better education, better management of Crown assets. Bad businesses being taken over, good businesses. These things just take time. What we're also seeing in New Zealand, and we're seeing it around the globe, is a lot of political fracturing. Now, ironically, some of that stuff could play into New Zealand's hands, because I think we're going to be an awful lot of better place to be than the likes of up in the UK. I think the UK is going to turn into one hell of a hotspot in regard to what's going on. And I'd really like to see New Zealand return to the political centre, whether that's a red or a blue hui. I don't really worry me, but it's really important that we do not have periphery-driven politics driving an awful lot of the decision-making, because that's the danger zone. Final observation, Troy mentioned Jandonomics. Jandonomics is my characterisation of what's going on around the globe. And Jandonomics is more flip-flops than what we see walking the beach at Bondi. So Lord knows where we're going to be in the next sort of 24 hours, but it's just, that's the world what we live in. And it's a 50s, 60s, 90s, 70s world, which is not a bad environment, but it's a big difference from the low volatility and reasonably passive world that most people's workforce experience has been aligned with over the past 20 to 30 years. So I'll stop there and happy to get into questions, Troy.
Thank you very much, Cam. What I should have said, because I didn't give some people who may not have heard you speak before the heads up that Cam is a straight shooter. So, definitely what you get today is nice and balanced, but you would hear it very straight down the barrel. So, Cam, I love today's session. Thank you very much. Just so people know, we are going to take some questions, but what we did is we asked some questions at the outset. So I've actually got 5 or 6 questions here that kind of came through from people who had registered. So Cam, I'm just going to kick straight into it. New Zealand's economic outlook. If you were a business leader planning for the next 12 to 24 months, what should you be realistically planning for?
Worry about the micro, but be 100% fixated on micro. So when push comes to shove, look, if you have a look at what we're seeing out across New Zealand, Troy, when you look at some retailers that are going well and some others that are not, some building companies that are going well, some others that are not. Yeah, I'm not going to name names here, but you've got a big dairy organisation that's gone pretty well, and there's another dairy organisation that hasn't gone so well. The red meat company down in Invercargill got into trouble. Well, some of the other red meat companies have been going pretty well. So one size does not fit all here. I get quite excited when we go through these sort of shakeouts because you find out who's any goddamn good. And good businesses, good players should be looking at the next sort of 12 to 24 months with a little bit of excitement. Because that's actually when you can make your best decisions, your boldest moves, when there's still a little bit of stress in the system.
Next question, Cam. So cost pressures, households and businesses. Many people are feeling cost pressure at the household and business level. How do you see that evolving and what tends to ease first? I know you've spoken to a wee bit about rates bills and energy bills, but what's the wider view on that?
I think the bigger picture here is 2% inflation still the right target? Because 2% inflation was pretty easy to achieve when you lived in a globalized, connected world, where China's just shipping a whole lot of cheap stuff around the globe. When you look at rates, you look at energy costs, you look at what we're seeing in regard to globalization, it just looks like 2% inflation is going to be hellishly hard to achieve consistently. So maybe the new normal is 2.5, which is what Australia targets. I wouldn't like the target to be 3, but we're going to see a lot more sticky, stubborn inflation pressure coming through what's called non-competitive parts of the economy. Energy companies, rates. You look at what we see in regard to medical insurance, that sort of stuff. What I'd really like to see, and I think Australia and New Zealand are going to have to need to go down this route, because the OECD had chapters in the economic surveys for both countries on competition pressure. One of the big drivers of innovation and productivity growth is actually competition. And we need to drive a lot more savings into the economic equation.
Next question. Unsurprisingly, we had a lot of questions around the labour market, and I know you spoke to it, really in depth there. I guess people might be asking, so from your perspective, what's the real state of the labour market if you widen that out, perhaps outside of Wellington into wider New Zealand? And I suppose what's noise versus a signal? What would give you, or what should our people be looking for in relation to a signal around the labour market?
So the labour market is very multi-tiered. So if you look at the headline rate, the headline rate's 5.3, which is actually still historically a pretty low number. If you're aged sort of 16 to 24 and 16 to 29, the unemployment rate's not 5.3. The unemployment rate's double digit. If you're Maori or Pacifica, the unemployment rate's not 5.3. The unemployment rate is close to being double digit. If you're aged sort of 40 to 59, the unemployment rate is probably somewhere around 2.5%. So you think, what's the problem in regard to what's going on here? So figures can tell you, well, there's that great adage, damn lies and statistics in regard to what it tells you. One of the indicators the indicators we look at are job ads, those sort of things for a turn in the market. But I keep a pretty close eye on hours worked. Because when you start to see hours work move up, it's a leading indicator, and it's the logical one to pull, because there's there's cost in regard to attracting labour, there's risk of putting someone within your business. You want the right person, that sort of stuff. But there's only so much you can get out of hours work before you need to pull the trigger on actually physically employing an additional head.
Yeah. I'll add one sentence just to that, only because we're in the space. We've probably had a 15-month trend of greater level of jobs, both contracting and permanent. And as we start this year, we're seeing, at some parts, like a doubling of the opportunities sitting at the moment. So my sense of the data, our data, is certainly there's been a slow incline trend that we are seeing more opportunities month on month on month on month on month. So,
well, the other thing, Troy, if you think about, normally when you get into an economic upswing phase, and we are getting into an upswing phase, it's not going to be as fast as what we've been used to, but it's still an upswing. Normally we get into that upswing phase when the unemployment rate's got a 6% number in front of it. Like, we're going to get into that phase with the unemployment rate's 5.3. So it's not going to take much of an upswing before we're going to be back to where we were sort of 2 years ago. I'm thinking, where is everybody?
Next question, sector momentum. Are there particular sectors or industries that you feel more optimistic about, more cautious about? What might happen in the next few years, do you think?
It's a lot easier. Look, yeah, there's a lot of exciting stuff that's going on with tech. There's a lot of exciting stuff that I think is going on with utilising natural resources. There's a lot of exciting stuff that's going on with segments of the rural community across New Zealand. Defence, if we're going to take defence spending from 1 to 2% of GDP, that's a pretty big increase over the next 5 to 10 years. You probably don't want to be getting a lot of growth out of defence spending, but that's where some stuff is going to come from. At the other end of the pack, the construction sector, the housing market, is going to take a while to recover. We're going to continue to see some stress out of that sector because the fundamentals are just not yet in place.
My final big question for you, what would a smart leader do right now? And I think leader being, you make an interesting comment, because the one that really struck me is, you're trying to get really good advice to business, but then we've got really good advice trying to get to SME. We've got really good advice trying to get to households. I don't know if you can break your answer down to those three parts, but if you were thinking about what is the smart advice you would give to a household, what is the smart advice you'd give to a SME, or what is the smart advice you might give to a business leader? Can you answer that, Ken? What do you think?
Yeah, a couple of things. Number one, throw out your 20-year playbook. Right? Don't take your guidance as to what's going to take place over the next 10 years as to what's taken place over the last 20. Don't base your cost of capital, for instance, over the 20-year average we've seen recently, because that number is going to get blown out of the water. What I also think is that, New Zealand's got that sort of syndrome where we just like to, God, we're downbeat about stuff. We're going through at the moment is what we need to go through. For the kids of tomorrow to inherit a better economic future. Now, I look at that with a little bit of excitement. I found it incredibly frustrating, for about a 10-year period when you're seeing the housing market go nuts, which at headline value looks really good because you're making a lot of money. But when you sit there and you think about the economic consequences of this generations down the track, that there's no way it was going to be self-sustaining. So it's a bit of the hard yakka that we're starting to see. I think it's really good. I like those anecdotes out of the likes of the freezing works down south. There's a big major New Zealand corporate listed company, won't name them, but they're a retailer. They suddenly found they had 270 too many jobs in head office. How do you suddenly find you had 270 too many jobs in head office? That's like, seems like a big number. We've just got to bite the bullet and get on with the goddamn thing.
Cam, closing words. Is there anything that we haven't discussed today that you think is really relevant? Anything you kind of went, shit, I missed it in my 40 minutes. Is there anything else you want to cover off today?
No, I just there is too much focus in New Zealand on the next OCR move, or what the Reserve Bank is going to be doing. Look, if the next 25 or 50 basis points of interest rates going up or down is going to have a material impact for your business or what's going on across this economy, then we've got bigger problems to think about. Yeah, we need to wean ourselves off just the importance of the Reserve Bank and getting back to good old-fashioned basics, which is all about microeconomics. And that's what individuals do. And when individuals are doing the right thing, guess what? You get collective mass.
Love it. Cam, you have been a champion. I hope everyone out there has enjoyed today's session. I hope it's been useful for you. We have recorded today's session, so it will be put back out to you. I know someone like Shelley sitting in our business will love the fact that you kind of hit on policy. My closing remarks would be, I suppose, from our business perspective, to say it feels like things have shifted. Our activity across the board is in a more consistent state. My view, same thing happened last year. My hope is that we just get through that April holiday period, which looks like it's already going to be different, because that's where we kind of had that little false start last year. But for today, Cam, thank you very much. Thank you everyone for joining us. I really appreciate it. Have a good rest of your day.